We're going to focus now on Wall Street and sustainability. Let me bring up my Fortune colleague, Adam Lashinsky, and his panelists. Here to share their views are David Blood from Generation Investment Management. Hi, David. Abby Joseph Cohen from Goldman Sachs, and Tom Steyer. Welcome back, Tom.
How you doing? Nice to see you.
Thank you very much, Mark. And welcome to the afternoon Goldman Sachs reunion. Actually, it's not completely true because Abby Cohen has not left Goldman Sachs, but Tom Steyer, who for many years ran Farallon Capital Management and is now doing other things that he'll tell us about, began his career at Goldman Sachs. David Blood ultimately was the head of Goldman Sachs' asset management group before starting Generation, which is a sustainable investment organization based in London. And Abby Joseph Cohen, the famous Abby Joseph Cohen, is, among other things, senior strategist for Goldman Sachs. We're gonna talk about money for a little while, and the conventional wisdom regarding sustainability is that the capital markets don't really care. The capital markets care about making money, and they don't care about making the world a better place, as it were. I want to start by framing the conversation around this concept of the carbon bubble. And David, I wanted to ask you if you would just explain very briefly to the uninitiated what that means.
Okay.
In an investment sense.
In an investment sense. Well, it starts with the question that if we as a society want to keep to not raising global temperatures by 2 degrees Celsius, the analysis is, well, how much of the hydrocarbons that are currently in the ground, both gas, oil, and coal, can we burn safely to stay within 2 degrees Celsius? And it goes on to then analyze the different reserves of the different hydrocarbon businesses, publicly traded hydrocarbon businesses. Of course, that's just a small piece of it. And the conclusion of the analysis is that if we were to indeed keep to what scientists are telling us is a safe level for temperature rise, then more or less between 60 and 80% of the hydrocarbons that are currently reserves that are being priced by the market would not be able to be produced. And that's the notion of a bubble associated with carbon.
And so the investment thesis there is that if you are invested in those assets, you are making a poor investment. Is that correct?
Well, the question is around timing. But that is the ultimate conclusion, is if you believe that there's going to be a price in carbon or global agreement on truly limiting the temperature rise, then if you have a significant exposure to hydrocarbon-based assets, then you have a significant potential write-down.
So it's interesting. One of those variables is if you believe there is going to be governmental action.
Correct.
Abby, your perspective on that?
It's a little more complicated than I think some of the proponents talk about. And let's talk about some of the details. About 90% of the reserves are held by governments or state-owned oil and gas companies. So it becomes a little tortured, if you will, to assume that all of the write-down in reserves has to take place on the part of the public companies. The other thing that is quite important is to look at who has the reserves and reserves in what. We all know, for example, that coal is by far the most problematic. It has the highest carbon footprint. It also has the particulate emissions and so on. And when we take a look at where those coal reserves are being held, we see a good deal of it is held in China, for example. And so one has to ask the question, how much can we squeeze some of the Western-based oil and gas companies when in fact a good deal of the problem is emanating from China? There's one other possibility that we could talk about, and that, of course, is abatement and some of the other things that could happen. When you use the expression bubble, it assumes that there's something inflated and it pops instantaneously. As we talk about what is most likely to happen in the years to come, whether we introduce carbon pricing, enhanced energy efficiency, cleaning up the carbon that we have, and so on. It's something that's much more likely to be a multi-year process, so not so much a popping of any bubble.
And before I move on to Tom, who's exciting me by scribbling notes furiously as you're speaking, if I interpret you, this all sounds very theoretical to me, and so you've been so good over the years at taking a stand on an investment thesis, right or wrong. So by saying that this is a multi-year issue, is that another way of saying you would not be in the camp that says that this, and I'm putting this very simplistically, is a bad investment now?
That is overly simplistic, number one. And number two, I do not have the responsibility at Goldman Sachs to make the call on energy-related companies. But my research at the Global Markets Institute tends to be much more macro-oriented and much more long-dated. And one of the interesting things behind the arithmetic of the carbon bubble is to indicate just how significant a problem this is. But where I think the analysis has been overly simplistic is to assume that the burden is going to fall on a very small number of the holders of those reserves. So will we ultimately move in the right direction by enhanced energy efficiency, cleaning up the oil and gas, shifting from coal to other things? We believe that that is in fact the case, and in our own work, we tend to focus in on those companies that have the cleaner reserves, and also those companies that are using their cash to develop better technologies and also to move into other things, including renewables.
But also, in this analysis, in just a few words, what is the likelihood of governmental action, either in the United States or Europe, in the next? We've been doing this conference for 6 years now. Each year, it has been right around the corner.
We have been tracking this, and we, of course, have been discouraged, as have many others, in terms of the lack of progress, particularly at the congressional level, the federal level in the United States. McCain-Lieberman didn't get anywhere fast, and there really has not been a serious attempt since. However, we do see progress in the United States. So, for example, the Obama administration has been using the EPA to move forward. We know that there have been many activities undertaken at the state and local level. And then the thing that we can track most closely is what's happening at the corporate level. And what we find is that there has been enormous movement in the right direction. You know, even before the SEC talked about requiring disclosures about climate impact, most of the companies in the S&P 500 were voluntarily providing them.
Although I want to caution you, when you say in the right direction, that's not necessarily an investment concept. And I just want to put a pin in that. I want to give Tom an opportunity to weigh in on this topic of the carbon bubble.
Well, I mean, the first question in asking of how things are being valued is to understand that there's no pure valuation metric here. And so when you look at these companies, the question is how much value are they putting on long-dated reserves or not? You know, there's a question of how much cash they're producing in the short run and returning to their shareholders. So the valuation really makes a lot of difference in terms of thinking about something being overvalued or not, because you have no idea how, I don't actually know how the reserves are being included. But the point that Abby was making is an overwhelming point, which is if we're talking about carbon and global warming, we're talking about a global problem. We're talking about the necessity for a global solution. So every time we focus on the United States of America, where in fact Abby's right, some of the trends are going in the right way, we ignore the rest of the world where the trends happen to be going in the wrong direction, and overall you'd have to say we're producing more carbon dioxide every year than we did the year before. So really when we think about the valuation and the politics, we have to look at this and say, what is the political mechanism that's going to get us to a global solution? And what we're doing in the United States is important, it is significant, but I think that it would be misleading to suggest that what we're doing in the United States is leading to a global solution in the short run, or even a national, the pricing of carbon
But do you have a thesis, or do you have a perspective on the investment thesis? Is there a danger of investing in these assets because of this potential for action that would create a bubble?
Okay, so David's point was that we have multiples of the amount of fossil fuels that we can ever produce if we want to stay within the guideline that 192 countries, including the United States, said was the guideline, which is 2 degrees Celsius. So do I think that that math is correct? It's absolutely correct. And do I think that all of those all those fossil fuels can be produced and that we can do it safely? No, I don't believe that. I think David's right.
David, please.
Well, actually, what I'd like to expand the whole question around carbon bubbles to say this. If the International Energy Association in October or November put out their projection, and what they said is really interesting and concerning and talks about another bubble. So what they said is that in 2030 or 2025, whichever sort of time frame you want to think about, the percentage of our energy mix will be about the same hydrocarbon-based in that time as it is today, which is about 85%. And then they go on to say that if that is indeed true, and that is their base case, that we'll have a little less coal, a little more gas, but more or less 85% of our energy in 20 years from now, 15 years from now, will be exactly as it is today. If that is the case, then the probability that we will achieve 2 degrees Celsius is 0. And in fact, the higher probability is that it'll be 3, 4, or 5 degrees Celsius temperature rises. In that case, then we won't have necessarily hydrocarbons that are stranded because we'll have burned them. In fact, what we'll have is agricultural lands, cities, and other stranded assets. So this question around stranded assets is one that we're going to have to face as long-term investors, whether it's a hydrocarbon-based question or whether it's a broader question. And let me tell you, if it's a broader question, it'll be a lot more complicated.
Well, this is the perfect segue to the question that I framed at the outset, which is, to put it very bluntly, do the capital markets give a damn? Which is an opportunity to ask you to explain what you're doing with generation, please.
Well, I'll answer generation just very quickly in 1 second. But I think what you're seeing for capital markets is that they're very efficient. They're very good weighers of information. And what capital markets are saying to us right now is, in fact, what the IAE has said, is that we are not going to have a global price on carbon anytime soon, and that the probability of those reserves being burned are quite high. Which is why I'm saying, well, let's expand that conversation to say that it's going to be much broader than that.
Excuse me for interrupting you. So then you're saying that, to put it bluntly, the markets have judged that no, in fact, they don't care.
Well, they've not worked out that actually that there's the other side to it. So oftentimes people are saying, look, in the next 5 years, we just don't think there's going to be price on carbon, therefore it doesn't matter to the price of Exxon. And I guess what I'd like to say is that if you're a long-term asset owner, then suddenly if you really think that that is the outcome, then you have a whole series of other problems that you need to start analyzing and factoring.
Briefly, Tom, before David talks about his life's work.
Well, I think David is implicitly making a more disruptive point than he's admitting to, which is this. He's basically saying that if we, in fact, burn those fossil fuels, there will be events that have to occur as a result, which are extremely disruptive for our economy. And, it's not as if those events are going to happen and nothing's going to result from them politically. In fact, the likelihood that we're going to have these outcomes and there are going to be these disasters and no one's going to react to it, I would view as extremely unlikely. Because I think that in thinking about this problem, I think it probably is true that people look at the politics today and say it's unlikely that anything dramatic is going to change in the near term. But the fact of the matter is, if the scientists are right, which they pretty much all agree, and the events occur the way they're predicting them, that will, in my mind, almost inevitably bring political reactions that will be dramatic.
Okay, so given these scenarios that you're all grappling with, I will ask each of you, starting with David, is how should we invest into these scenarios? Because you're actually doing it.
Yes. Well, our view is actually, in a nutshell, that long-term investing is best practice. That actually in this day and age, there are way too many short-term investors, and so therefore it's a great opportunity to be a long-term investor. And that sustainability issues, we're talking about the environment, but they're broader still, social issues, governance issues, drive the success of businesses, and therefore, if you're a long-term investor, you should integrate sustainability into how you're analyzing the quality of businesses and quality of management teams. It's not a value for values conversation, it's just what we hope to be best practice investing. And what that would also tell you is that, going back to Tom's point, that in fact, you would have to say, well, I don't want to have that kind of exposure. I want to build a portfolio that reflects the fact that we're going to need to transition to a low carbon economy very quickly, much more quickly than we're currently doing. And where should we place our bets, if you will, to make that transition?
And give us an example of how generation has approached this issue. Specifically how?
Well, we would, for example, in the transition to a low carbon economy, be investing in businesses that do not rely on subsidy, do not rely actually on public policy change in the short term, but that are just driving smart businesses or smart outcomes right now. Energy efficiency, for example, is a very good example of something that we would be investing in.
Energy efficiency, and can you invest in public securities, I believe, right? So can you talk about a big holding and how it exemplifies your thesis?
Well, I usually try not to do that.
But there's there's no regulatory reason why you can't, right?
No, there's none. So we have zero hydrocarbon base assets.
So you don't own Exxon or Chevron or Shell?
So we have $8 billion of assets, and we have no energy, materials, investing, those sorts of businesses. We have, in fact, a series of businesses extremely diversified across all three of our strategies that reflect this transition to a low-carbon economy, as well as other long-term sustainability issues.
Okay, Abby, I'll ask you the same question. Given there are a lot of scenarios at play here, how should one invest?
I'd actually like to answer two questions,
Please do.
if I can, because you
Not
asked,
the one he asked, though.
I'll get around to it. But Adam, a few moments ago, also asked whether investors care. And I'd like to give the market geeky answer, because I think it's important for you all to understand. In the 1990s, some academic work was published that basically showed that portfolios that were run that cared about green issues didn't perform particularly well. Didn't perform particularly well relative to benchmarks like the S&P 500 and so on. And for several years, the results of these academic papers were used by university endowments and pension funds and so on as reasons why they should not be investing in a green manner. Because after all, those managers had a fiduciary responsibility to the universities, the charities, or to the pensioners who were ultimately receiving the money. And we thought that that work was probably not right. Why? Because markets can be inefficient. Markets were not paying attention to a whole variety of green issues, be it carbon, energy intensity, and a whole host of other things. And our work began to show by the mid-2000s that, in fact, investors were paying attention, that within an industry, the cleaner company had a higher PE ratio on its stock, and its cost of debt capital was lower. So there was, in fact, a premium for being a, let's call it a more sustainable company in this space. The market geeky comment now is that during the financial crisis, these correlations went away because investors again began to focus in not so much on these longer term issues, but the short term issue. What's the cash flow from the company today? What's the dividend yield? And so on. I am hopeful that we're now beginning to see the movement back towards paying attention. Why do I think that? Because for the last 6 months in particular, we see that investors are asking us questions about the long-term economic growth, and many of these other long-term challenges and opportunities. So I, for one, am now more encouraged than I have been over the last 5 years, but the proof will be in the pudding. Now, to answer your second question, what are we doing about it? David and I, and Tom and I, are in different businesses. David, for example, is a portfolio manager. I live in an investment research department. So we provide the material, the content that portfolio managers can use when they make their decisions. And we, in fact, have committed a good deal of our own internal resources, that is our people's time and effort, to think about these issues. We have, for example, something that we call SUSTAIN, which is a framework in which we look at the sustainability of various companies and industries. ESG is one part of it. We look at some other things, including quality of management, focus on community issues, and so on. But what we find is there's a very high correlation between companies that are financially sustainable and well-managed and those that are paying attention to these issues. And do our analysts look at this? Absolutely. And we don't segregate it. Every analyst following every company tries to score the companies that they look at on this basis. So yes, we take it very seriously. I will say that our portfolio manager clients in the United States, by and large, are not quite as interested in this topic as are our portfolio manager clients in some other parts of the world, including Europe.
Interesting. Tom?
Oh, I'd make 3 points, I think. The first one is, I think it was Herman Kahn who said, if things can't continue, eventually they'll change. And that's really true, that you can't tell when they're going to change, but if you know that you're in an unsustainable condition, you know that at some point it will change. And my experience of markets has been that markets are very good at extrapolating lines and not often particularly good at seeing breaks that are inevitable but uncertain as to timing. So I'd point out the subprime debacle, where I think there were a lot of people who knew that it would eventually end, but no one knew when. I'd point out the tech bubble, and I agree with Abby about the word bubble. It's a very misleading word. I agree, and I think it's misleading here as well. But in the technology bubble in the late 90s and the LBO bubble in the late 80s, in each case, markets tend to extrapolate lines, assuming that the current status quo will continue. What I would say is that I think that the way that this will be solved will actually be through investment, will be through the private sector, will be that the experience of when we've had environmental problems, they have been solved by policies being put in place and private companies coming up with solutions that no one had ever thought of. And so if you look at acid rain, if you look at the hole in the ozone layer, under Republican administrations, we put in policies that incented businesses to solve the problem, and they solved them faster, cheaper, better than anyone had ever imagined. So from my point of view, what I expect and what I think is inevitable is that eventually the politics will fall away and we'll be forced to come up with the right policies. And then the private sector in the United States of America, which I have almost limitless faith in, will work its ass off to solve the problem.
So I want to go to the audience, and we've primed the pump and asked a couple people to have questions ready to go. And the first one is Andrew Shapiro of Broadscale Group. Andrew, where are you?
Right here. Thanks,
Please.
Adam. So picking up on Adam's starting point, which is that we've been for 6 years coming here and talking about when government will act, and also this thesis that we are living in the time of a carbon bubble. I'd like to ask the panel, particularly you, Tom, what can the private sector do, particularly the investment sector do, to move more capital into that solution set that you were just referring to? I mean, we've got innovation happening in investment right now. We've got crowdfunding happening. We've got corporations that are sitting on more cash on their balance sheets than they've ever had, and they're starting to do more investment in this sector. But it's not happening fast enough. And the acid rain analogy is interesting, but there was a market signal that government gave there.
Yes.
The market has not done that. Government hasn't done it. So how can the private sector get together, the largest banks, the largest fund managers, and say, we are going to incentivize or drive more investment into this sector in order for Abby's prediction to be right, which is that companies that are cleaner and more sustainable will have higher PE values, higher valuations.
Let me cut you off in the interest of time. Go ahead.
So I think that there are two things going on here, and let's start with the overwhelming fact that we have a political problem here, not a science problem, not a policy problem. We have a political problem in terms of putting policies into place that will incent companies to do what they want. I think what companies can do is they can push for basically more information being required that's material. And I think that is something that has to happen. I think when companies are forced to put in information, then investors will look at it, and that's a big step in the right direction. But it's by no means determinative. Because let's say everybody had to put out all the information, Abby would crunch the numbers, David would look at the investments with a different discount rate in the future based on the probability of government action. But the fact of the matter is, what is going to deter, it's nice that people want to be nice, but the way these things get solved is when government changes the framework permanently and everyone goes, those are the new rules, we will now abide by those.
But let me play devil's advocate, and I'd say to Andrew, we don't have a problem at all. I mean, for example, billions of dollars were invested in solar panel manufacturing in the United States. It was largely wasted, but that's a great thing for the market. That capital was allocated, it didn't work. No problem getting capital allocated for green initiatives, right?
Well, wait a second, are you saying?
I'm saying the system is working and that there's capital available. It's not always going to go, it's not always efficient.
Well, wait, I think you're missing one point, which is this. There is capital available to do intelligent things, and I think we have great capital markets, but until the policy framework says, doing this, you're going to have to pay for all your costs, so you're going to have to pay for the health costs, you're going to have to pay for the carbon pollution. Until that's included in the formulation, then people are going to not include it. If I'm allowed to take my garbage and dump it in Abby's yard, I can have a really cheap garbage solution for myself.
Okay, well, one more that we've arranged, which is Amanda Starbuck of the Rainforest Action Network. Where are you, Amanda?
Hello. I was very intrigued by a couple of comments that came from the panel about when are we going to get the wake-up call that spurs us on. Rainforest Action Network, we've been challenging the largest banks on Wall Street to shift their financing from fossil fuels into clean energy for quite some years. And last year, in late October, we brought out our most recent report, which was asking banks to consider the carbon emissions that they're financing. And we planned our report to launch the last week in October. And the day that we sent it out to Goldman Sachs, Citibank, all these fine institutions on Wall Street, we received auto-responses because Superstorm Sandy had evacuated Manhattan. Something really ironic about that. But unfortunately still, although we're seeing these billion-dollar commitments into clean energy, the status quo on Wall Street is to continue putting billions of dollars into coal and oil. And I'm inspired by Linda Greer's presentation about the China risk.
But what's your question for them?
The question is, what is it going to take to get Wall Street to start actually monitoring the emissions that it's financing, rather than monitoring environmental performance amongst these companies, specifically on operational performance, just as we've seen before, and how are we going to take this issue from not specifically looking just at the US, but globally as well? So that's two questions.
It certainly is two questions.
Who wants it?
I'll begin and say that I think it's extraordinarily important to recognize that this is indeed a global problem. If you take a look at where the United States is relative to some other countries, our energy intensity, that is how much energy we use to generate a unit of GDP, is 1/2 that of China. And we are also generating just about 50% or 60% of the carbon emissions of China. And so one of the things that we really have to focus in on is the fact that US companies have in fact become more efficient. They've been paying much more attention here, but the global situation is becoming more problematic, in part because of where the economic activity has been shifting, including to places that are very much heavy into coal. When you talk about getting the attention of Wall Street, that's sort of like an easy throwaway line. What we need to be looking at is what companies are doing. I can talk a little bit about what we see happening in the US. We do see that US companies, I'm going to talk first about outside the energy industries, are paying much more attention to this category. Even before the SEC required disclosures in the annual reports, something like 85% of the companies in the S&P were giving us some sense
Let
of
me
their
interrupt you,
green
Abby.
profile.
I feel like you're dodging her question, or maybe you mean to, which is to say, in your opinion, it's not Wall Street's responsibility, it's the polluter's responsibility, it's the issuer's responsibility, not the investor's responsibility. Is that what you're saying?
I think that we need to look at what the companies per se are doing. There are Obviously, responsibilities on the part of Wall Street firms. Goldman Sachs, I didn't want to make this personal, but I shall. Goldman Sachs has turned down any number of underwritings where we felt it was not in the best interest. So yes, we do apply those kinds of standards.
Go ahead, David, and Tom, quickly.
Yeah, there are $40 trillion of long-term investors. That's pension funds, sovereign wealth funds, foundations, endowments, family offices. $40 trillion. We really need to, in addition to companies, Wall Street, we really need to be focusing on that group of assets to really mobilize, because frankly, their interests are absolutely aligned with long-term sustainability.
Tom?
I would say this, counting on the goodwill of private enterprise, which I have said I have enormous respect for, is a mistake. It is absolutely a mistake. What we need for this to happen are rules so people will put it into their spreadsheets, whether they work for companies or whether they work for investors. And they're no longer saying there's a 20% chance of a rule. They're now saying there's a 100% chance of a rule. Let's figure it out, ladies and gentlemen. That's one point. Secondly, global. It's a political problem. I don't think I'm being just a parochial American to say we are the essential country. Abby's right, we aren't the biggest polluter. We are the biggest historical polluter, and we're the biggest per person. So if we're going to go overseas and ask people to accept rules, we are going to have to lead in a way that proves that we are serious about it and we're willing to make sacrifices to get it done, because we're going to be asking them to make sacrifices.
We as a polity, I think is what you're saying, right?
Yes, we are the essential country for technology, money, and morality. And I don't think there's another country that can do it without us. We can't do it alone, but we have to be part of a leadership group to make this happen around the world, or we will fail.
I hate to end things just as we're heating up, but that's exactly what I need to do. Thank you very much. Thank you, David. Thank you, Adam. Thank you, Tom.